Good morning from London. This is Bloomberg Markets Today. I'm Kriti Gupta alongside Tom Mackenzie. With the cash trade just less than an hour away, here's what you need to know. Bonds sell off overnight after Fed hawk Neel Kashkari says the U.S. central bank's policy is restrictive, but rate setters haven't entirely ruled out additional rate hikes. With just hours left on the clock, BHP requests an extension for the deadline for its bid to take over Anglo American. We're going to dive into the details. Plus, South Africa heads into the closest election that could reshape a political landscape dominated by the party that Nelson Mandela led to power.
OK, let's check in on these markets then. The bond sell-off as a result of what we've been hearing, not just from Neel Kashkari, of course, not a voting member, but hawkish in his comments anyway, but also the tepid demand for the issuance of US Treasuries, $70 billion of 5-year Treasuries, the weakest demand in over a year. And then the Consumer Confidence Survey. The good news is bad news in terms of the market reaction to that story then. European futures pointing lower by 0.3%. The FTSE 100 here in the UK pointing lower by 37 points, off by 0.4%. The US 10-year as yields popped 8 basis points yesterday with a sell-off at 4.56 so far in the session. Euro dollar 108, softer the single currency by 0.1%. Markets today starts right now.
Good morning. Good Wednesday morning, if I can. We're going to get right into it. There's a lot doing on in the macro space. We've got plenty to talk about in the bond market. But first, we should talk right into some of the biggest deal news that we're getting. Headlines coming out of BHP talking about that update. Remember, the deadline was about 5 p.m. London time here. It looks like they're already requesting an extension when it comes to Anglo American. Already some sticky pieces in terms of what that spinoff of those 2 African mines in South Africa actually looks like. It doesn't look like there's any real conviction here that this is a deal that will ultimately go through.
That had been the focus, absolutely, was the Anglo assets in South Africa, given the demands by BHP that those spin those off, because investors within Anglo were exposed potentially to risks around that, given it could take 2 years on the regulatory front to approve that. So clearly there was some pushback and discomfort among some of Anglo's major shareholders to just that part of it, whether or not value is a question as well. $49 billion. The line's crossing then, just in the last few minutes, BHP saying the proposal does offer substantial protection for Anglo holders on that point. Also saying, though, there's no certainty that any pact or transaction will be reached. The deal was for 5 p.m. today, the latest deadline, I should say. And as you suggest, and as you've mentioned, they've suggested they're going to be pushing that time frame back. They want to give themselves more time. It suggests maybe that conversations are turning a little bit more constructive between the two pairs. But we know that gap, it seems, at least on the information we have at hand, remains around the assets in South Africa. Yeah, and we should point out exactly what the hurdle was. Yeah. You talk about the mines in particular. One of the key sticking points here was that Anglo American, to your point, was saying the shareholders aren't being compensated for it, whereas BHP was saying we still need clarity on what kind of compensation you're actually looking for. It felt like there was a real miscommunication there in terms of where they were actually going. Anglo, I believe, reported, and again, these are just reports, this was not acknowledgement from the company itself, but basically saying that at the end of the day, we actually just need acknowledgement, we'll figure out the pricing later, but just acknowledgement that somehow these mines need to be part of the share price. On top of that, to complicate the issue even more, we talked about South Africa. Those 2 mines, of course, are crucial. But if you look at their long-term assets, about 1/5 of Anglo's assets come from South Africa at a crucial time for those South African assets. We know that the government is at risk of perhaps centralizing some more of those assets when it comes to the mining story, et cetera, if indeed that ANC majority is taken. We're going to dive into the South Africa piece in a little bit, but it looks like this BHP Anglo story is going to last a little while longer. Yeah, because on the regulatory front, in terms of these demergers, if that's what comes to pass, the demerger story in South Africa from the regulatory front could take up to 2 years. It's a redhead right now. BHP wants the Anglo bid deadline extension to allow for more talks. So BHP pushing for that deadline, which have been set, the latest deadline, 5 p.m. UK time today. BHP saying they want that Anglo deadline, the bid deadline, extended to allow for more talks. We'll see if that extension comes through. But clearly BHP thinks they are making some progress on this. And
remember, the value is still about $49 billion.
Yes.
That is still the number that we are looking at. And this is the second extension that they've requested. We still have to wait to see if Anglo actually agrees to that extension or if they just say, look, hands off, we're done negotiating here. So, of course, we will keep you apprised of those headlines. In the meantime, let's talk about the South Africa component of it as well. Because not only are we watching the BHP Anglo read-through, we're also watching the macro read-through. I did a little nerdiness, as I'm known for.
Shock horror.
I know. A little bit bit of a scandal on this Wednesday morning. Talk about the bond reaction and the market reaction here. I thought it was interesting. We were looking at the bond reaction. The South African polls, I believe, opened at about 6 a.m. London time today, so about an hour ago. But they had a bond auction yesterday that surged. There was so much demand for this. And the thought process, when you look at some of the kind of investor commentary around it, was on the one hand, either you buy very cheaply, bonds rally on for favorable outcome. If not, if it isn't a favorable outcome for the markets, South Africa still offers one of the juiciest yields in the EM world. So this is a win-win situation for a lot of investors, and that really showed up in the bond auction.
Is that where the money from U.S. Treasuries went then? On 455 wasn't attracting the buyers.
South Africa.
They moved to South Africa, you get a juicy yield, you're betting on some election risk. 3.5% gains for the rand versus the US dollar as well. Given the dollar strength, I mean, that's pretty remarkable coming through year to date for the rand. Sorry, I should say, since the start of April, 3.5% gain. So the expectation that even if the ANC sees their control chipped away and the numbers that they have in Parliament chipped away, which is the expectation, that you will still get some stability, that some of the policy framework will continue. They will partner with the less radical parties. That is the market expectation. It's a polling expectation. Of course, we'll see if that comes to pass. But the expectation that you get policy continuity, essentially.
And on top of that, you also have the piece of the threat of the other coalitions, right? If you look at everyone outside of the ANC, they're still vouching for that nationalization, a little bit more centralized control. Markets, of course, aren't going to love that. So when you're talking about, one, the continuity of the ANC, that's always a market-friendly outcome to have more of the same because you're familiar with that, but also this idea that it is a little less centralized in terms of policy.
And the economic challenge is something that Jennifer Dabasaja has been pushing her guests on as well, given the ANC in the last decade has overseen growth of just 0.3% on average per year. Let's cross over to Jen Dabasaja, who's standing by for us in Durban as this vote unfolds. Jen, what role then will the economy play in the minds of voters today in South Africa?
Yeah, Tom, I mean, I think you and Kriti were just noting just how complex this really is here because, yes, investors on the one hand are saying policy continuity is potentially a good thing. But if you just take a look at where the economy has been in the past few years, it's a bit concerning. And that seems to be at the core of what South Africans are really coming here to vote for this year. Right now, if we take a look at where the economy has been at, it has stalled. You mentioned 0.3% growth. This year, it's only projected to grow just over 1%. We have unemployment at just about 33%, and much of those people being young people. And of course, we have seen a lot of the dilapidated rails, ports, the electricity outages affecting productivity here in a country really that should be thriving. And so the economy is at the core of really what people are voting for today. And the question is, again, what does the makeup of the next administration look like? And how will they be able to address a lot of these fiscal reforms that are very needed here?
Jen, talk us through the jitters here. Why are South Africans a little bit nervous about the possibility of a coalition?
It's really interesting, Kriti. I mean, I'm standing in Durban, which is one of the main cities here in the province of KwaZulu-Natal. There are three main provinces that we're paying very close attention to. It is KwaZulu-Natal, it is Gauteng, which houses Johannesburg, and also the Western Cape, which houses Cape Town. And the question about coalitions, the concern really is what we've seen on the local level. There's been instability with a lot of these coalition governments that we have seen across the country. And so people are wondering whether or not this can actually work on a national level. But Durban in particular, it's fascinating. It is an ANC stronghold. Back when Jacob Zuma was president, this is where he got a majority of his support. But we're seeing a lot of support for a number of the opposition parties right over here. Next to me, I have Julius Malema's EFF party supporters here. And so many people are wondering what the makeup and the breakdown of support will actually be here. And just a few weeks ago, we were able to speak to Julius Malema about KZN in particular. Take a listen to what he told us.
After President Zuma announced MK Party in December, we went to KZN after December, had a successful rally in KZN where it is the base of MK, and that did not affect us. But from policy perspective, ourselves and President Zuma are not very far. And it's one of the parties that after the elections, it will be interesting to engage with.
So that was Julius Malema of the EFF party speaking about potentially engaging with the MK party, which is former President Jacob Zuma's party. And that is giving investors a lot of concern. You mentioned, of course, the nationalization of the Reserve Bank and mines. That is something that the EFF believes in. The ANC, though, has tried to at least see some of the fruit of their recent economic reforms come to light. And so if we are to see a coalition government for the first time in the ANC's 30-year rule, will they be able to get on the same page again about the economic reforms that are needed?
All right, Bloomberg's Jennifer Sabasaja walking us through what's going to be a crucial pivotal point in South Africa. Either way, we thank you so much for leading that coverage on the ground. She, of course, will be joining us throughout Bloomberg Television and radio throughout the day, covering that for us. In addition to the South African polls, look at some of the events we are following today, because in addition to the geopolitics, the election risk, we got plenty of data out as well. German CPI report due at about 1 p.m. UK time. Plus, of course, my favorite topic, that litmus test for the T+1 settlement changes, the double settlement coming out today. Remember, showing up from Friday's transactions plus yesterday's transactions. Can this market handle it? Feels like a lot of people are hedging their bets. Plus 7 p.m. UK time, the Fed's beige book. What kind of context do we get in terms of the possibility of additional rate hikes? We're going to dive into Neil Kashkari's comments in just a moment. Plus, today marks the start of those debt buybacks from the U.S. Treasury. The market consensus here is that it may not be that market moving, but still something to mark. It feels like, though, in the last 24 hours, the real headline comes out of the hawk, the Fed hawk of the Minneapolis Fed, Neil Kashkari.
Once a dove with wide wings.
I know.
Neil Kashkari. What a transformation.
Times have changed.
Speaking in London. And it just shows, I think, the sensitivity of these markets when you just lay out. And he wasn't making the base case in any sense.
Yeah.
But he obviously said and made the case that we have not taken potential hikes off the table. We haven't taken them off the table. Not the base case, but there is sensitivity to that kind of relatively hawkish commentary coming through from the likes of Neil Kashkari. But also with the auctions yesterday as well, of the 5-year. So pre-auction pricing coming in high in terms of the yields demanded by investors. And to what extent that puts a floor under yields in the weeks and months ahead? Or does the softening around the QT story, which is expected to start, in June from the Fed, does that ease some of the angst in the bond markets about the adoption, about the take-up of some of these treasuries?
Yeah, it's interesting that we're talking now about the floor when for so long we were talking about the ceiling in yields as well. And that was a conversation we had with Mark Cudmore, MLive executive editor, yesterday as well. At the same time, it's curious that we had some inflation data out of the RBA as well. They're basically standing put and saying, look, this inflation data is still coming in a bit hotter than we would like it for it to be, so therefore we're going to kind of stay. It reinforces that narrative that even though it isn't the base case that hikes are on the table, it does have wandering minds in the market wondering if that is something that's going to happen, at least in the back half of the year or in early 2025. I realize that we're barely into the summer of 2024, but it feels like markets are starting to think that way, especially when it comes to that floor.
The challenge of the last mile on inflation from 3 to 2. For most of these central banks, if their target is 2%, it does seem to be, the narrative seems to be forming that, yes, inflation continues to gradually edge lower, but at a much slower pace and a much less convincing pace, particularly for policymakers, for this last mile. And that seems to be more of a consensus view now and is being backed up by the data. There's a redhead crossing the terminal right now, by the way, on the energy front. ConocoPhillips in advanced talks to buy Marathon Oil. ConocoPhillips, of course, the US company, in advanced talks to buy Marathon Oil. That is according to reporting from the Financial Times. We'll keep across that story for you as well. Currently, markets then, in terms of the open today, pointing lower by 0.2%, and soggy as well in terms of US futures. S&P E-minis down by 0.4%, but the Nasdaq hitting a new record yesterday.
It is, and we should really talk about, again, very quickly, this oil merger story, because in the last 24 hours, we also got Hess shareholders approving their merger with Chevron. So there's a lot of consolidation when it comes to the energy space. On top of that, since we're talking about equities, going into the open, I should very quickly mention NVIDIA gapping higher. A fun fact from our very own Dan Curtis, our producer here, talking about the fact that in just the last 4 days, they've added the equivalent of LVMH's market cap in terms of 470
billion. It's remarkable.
Massive.
LVMH's entire market cap added in just 4 days. Wow, that is quite the superlative. All right, we will keep across the NVIDIA story, of course, and the recross to the Nasdaq and the broader tech space for you. But coming up, our coverage of the European parliamentary elections continues. Today, we're going to hear from one of the leaders of the European Greens. Plus, another deadline approaches for the mega mining tie-up between BHP and Anglo American. Of course, BHP, just in the last few minutes, calling for that deadline to be pushed back. We know the boards of the two companies are talking. We await the lines then from Anglo American. It seems there's a decent chance that 5 p.m. deadline could be pushed back. Up next, the dollar edges higher. Bonds sell off after comments from Neil Kashkari, as we've been unpacking for you, and stronger than expected US data, at least in terms of the consumer sentiment surveys. We're going to talk FX when we get back. If you have any questions of your own for our guests, ping them over to us on IB plus BBTV Go. This is Bloomberg.
You've been seeing the US economy is doing, on the surprise side, a bit more negative, and Europe, on the other hand, is doing a bit better. That's something we shouldn't forget. If you look at PMIs just recently, they're still in contractory mode, but I think they're increasing. And it's not only the service sector which is doing better. So I think that has also driven the euro a bit higher. So from our point of view, I think that could continue. Our forecast for euro dollar would be 110, say in 1 year's time.
Christian Nolting there, the global CIO of Deutsche Bank Private Bank, speaking yesterday on this program, saying that he's a little bit bullish euro. It's an interesting time for him to make that comment, given that so many people are saying, why is the euro so strong to begin with? Let's bring a little bit more context here. Alexander Yekov, head of FX strategy for Europe at BNP Paribas Market 360, joins us this morning. Thank you so much for joining us on set as well. Talk to us about this euro story. I'll start with, why is the euro so strong right now?
Good morning, and thanks for having me on again. Look, Q1 saw a series of upside surprises to Eurozone data. So the question coming into Q2 was, can this continue? And in that respect, the Thursday PMIs that were just referenced were encouraging. I think what's particularly encouraging is that activity data is holding up okay, even as inflation is slowing. So the ECB will view that as a positive. In terms of whether it'll reflect in the currency, we think a lot's already in the price. And from here, we're not bullish on the euro, largely because the euro lacks the yield to continue to appreciate against the dollar.
And when we're talking about any potential upside that there may be, even in the short term, give us some numbers here. What kind of range are we looking at?
Well, we don't think there's much upside in the short term. We think you're
downside then.
Exactly. We think you're better off playing it via euro proxies like Scandinavian currencies. We like the NOK there. That has a good story. But in terms of euro-dollar, that dollar strength we think will really dominate. That's because the dollar maintains its yield advantage and will do so for some time to come. We think the Fed will cut rates, but cut rates only gradually and only starting in December.
The pound doesn't have much of a yield advantage, does it? But you like the pound, up 2% versus euro year to date, at levels we haven't seen since 2008 versus the Japanese yen. What's your call on the pound? How do you play pound strength?
Yeah, we do like the pound. We think the market may perceive a landslide victory at the UK elections as ushering in a period of political stability that could lead to sterling or to inflows into the UK and in turn a stronger pound. I think the market's already started to price this, though, Tom. So when we look at our positioning metrics, the market's already bullish on the pound. In fact, it's the largest long in the G10. Nevertheless, we think it can continue to appreciate. And the BOE here is an important piece of the puzzle. Yeah. Yes, they'll start cutting in August, but we don't think if the cuts that are priced into the curve are delivered, sterling will be very vulnerable because it'll remain one of the higher yielding currencies.
So pound euro 117, what level would you be targeting with that cross?
So we think euro sterling can fall to 83 by year-end.
83, okay.
In terms of the dollar, though, because it feels like that is the game changer that you were mentioning, even for the pound as well, it feels like it's at the whim of it. Walk us through the game changers for the dollar. What are you watching for? Is it just about the yield, or are there other factors as well?
There's quite a few other factors. There's two in particular.
Give us a laundry list. Hit us.
There's two in particular that we're watching to see if we could be wrong on our bullish dollar call. The first is whether or not the labor market in the U.S. deteriorates. And here, if we see consecutive or multiple payroll prints below 100K, then we think that will prove quite dollar bearish. And the second is whether European growth outperforms or Eurozone activity data outperforms U.S. activity data. Now, the bar for both of those is very high. And so we're not convinced that, at least through that lens, the path for a weaker dollar is there.
How do you price in the concerns around the fiscal ceiling that the U.S. is dealing with right now? The deadline is January 2025, so right after the U.S. elections, the first thing on the president's docket. How do you hedge it? How do you play it?
think it's definitely something that's on the market's radar, but we're not sure it's something that the FX market in particular is focused on. The FX market is much more focused on the Fed. And the May meeting, for the Fed, reveals that the bar to hike is still quite high, but equally, in terms of rate cuts, you have core PCE above 2% still, so they're not going to be in a rush to cut rates. We think, like I said, in December is when the Fed will start, whereas the ECB, we think, will go in June.
OK, so it's a Fed that doesn't start until December. That has consequences, clearly, for the Japanese yen. 157 on the yen right now. What is more consequential for that currency? Is it a hike from the BOJ or a cut from the Fed?
I think it will be a cut from the Fed. And because we're not projecting one for some time, until December, we don't think dollar-yen or the trend in dollar-yen is going to change much. If anything, the path of least resistance is for the pair to head higher because the carry-on offer remains strong. Now, on the yen side of things, there aren't many positive yen-specific catalysts on the horizon. You see Japanese yields rising, but they're rising at a more moderate pace than U.S. yields. And when we look at Japanese investor behavior from the official data published, they don't appear to be repatriating foreign assets at the moment.
On the Chinese currency, the yuan, because there's a headline that crossed earlier today. It's at its weakest level onshore, the CNY, onshore since November. Is this a policy-making decision to allow a steady slowdown, a steady weakness coming through from the yuan to support the export market? What is your expectation around? There's a tension, isn't there? They do want to trigger outflows, clearly, or risk off around the currency. Is there further pressure to come through for the Chinese yuan? And again, to what extent is this a Fed story?
We think the story in dollar CNH is not too dissimilar to dollar yen, where we see room for moderate appreciation from here. Tariff risks and the good carry especially mean that risks are to the upside in that pair.
That tariff risk, though, is there a hedge against that?
There is. We think one good hedge in FX is the Swiss franc, where right now the Swiss franc is or the market holds very short positioning in the Swiss franc when we look at our proprietary models at BNP Paribas, and those shorts can squeeze on any risk off, including tariff risk-induced risk off.
But the shorts are based on, again, monetary policy driving the trade. Why would you choose the Swissy, of all places, as opposed to, say, the dollar, where the market is net long?
Certainly the dollar would be another expression, but when we look at where positioning is most extreme, which is the way that we would answer a question around where the move can be largest on risk off, then Swiss really stands out on our metrics.
Why does the NOK stand out for you, for the commodities currency story? What is it about the NOK that gives that support?
So the NOK is an interesting one in that it doesn't have the same yield as some of the high-yielding emerging market currencies, but it does have a lot going for it. It has a central bank that is less dovish than other central banks in G10. It has a positive flow story, we think, because the Norges Bank is recycling fewer NOK than it did in prior years, especially the last 2 years. And positioning in NOK is light, so the market doesn't have the trade on yet. On that basis, at least according to our metrics, so on that basis, we like the NOK.
OK. Thank you very much indeed for the analysis, the view there on the NOK. Alexander Jekov, head of FX strategy, a call there on the dollar as well. And maybe a little caution when it comes to euro versus the pound. From, of course, BNP Paribas Markets 360 team with a deep dive on the FX space. Coming up, voters across 27 countries head to the ballot boxes next week to choose the next European Parliament. We're going to hear from an MEP ahead of that vote. This is Bloomberg.
The far right is strong because they are selling snake oil in a certain way. They are promising swift results and miracle solutions to problems which are deep and complicated. But I think it's very important to say that solutions and delivery has never come from the extremes.
We are in a campaign to fight. We are in a campaign to convince citizens to explain what is at stake. And what is at stake is the future of Europe. It's the choice between a strong Europe and a Europe which could disintegrate.
Nicola Schmidt, EU Commissioner for Jobs and Social Rights, and MEP Katalin Czech, giving their view on Europe's shift to the right. Staying with the region, the EU parliamentary elections, of course, kicking off next week. Nearly 400 million voters are eligible to choose 720 MEPs. Bloomberg's Oliver Crook is on the ground for us in Berlin with a guest. Ollie.
Yeah, that's right, Tom. You're just, as you set it up in the conversations you've been having throughout the show this morning about the EU election kicking off next week. I'm very pleased to be joined by Terry Heinke. She is a member of the Green Party in the European Parliament since 2014 and the co-president of the Greens in European Parliament. Thank you so much for joining us today in Berlin.
Great for being here.
So I'd like you, if you could, just to sort of set out for me what you think the defining issue of this election is and really sort of illustrate for us what you think is at stake.
I would say everything is at stake. There are two elections this year that can go horribly wrong, and the one is the European elections and then certainly the US elections, because what we are facing right now, if there is, for example, a surge of the far right, that the whole European project is basically going to be put in question. So that would have horrible consequences but for Europeans, but I think also across the world. And one of the key issues that we will be discussing is how we continue with the Green Deal. So will we go down the path of climate neutrality that Europe has taken course on, or will we have a back and forth and basically go back and with that not only not meet the climate targets but also create a lot of economic insecurity? And that will be decided by Europeans next week.
And so what do you think has happened, though? Because the Greens are sort of the party that have lost the greatest amount of ground if the polls are to be believed. What exactly has gone wrong, do you think? How do you diagnose that issue in the loss of the Greens there?
Well, to be honest, I'm going to have an analysis of the election after the election, because
Sure.
in the last election we were also not foreseen to be that strong, and then it really turned out to be a green wave across Europe. But of course we are in a different moment than in 2019, where, you know, the urgency of climate change was becoming very visible for people, and now we are talking about concrete measures. There is a lot of insecurity. People are concerned about the future. But I think especially in a moment like this, we have to make the case why the Green Deal is not only important for climate neutrality, but also to create green jobs, to have strong industry, to have strong economy in Europe, and that will be what we are trying in the next days.
And I think, but maybe one of the reasons that message isn't getting through, it seems to me at least, the perception is that the European approach has been much more regulate first, kind of put up rules rather than create incentives, more of kind of, you know, the Inflation Reduction Act model in the United States. Do you think there needs to be a different approach in order to get these sort of initiatives through?
Look, I think the setting of targets and regulating a certain frame, that was the right start. But you are absolutely right that I think we now need to also enable to make this happen, because we are now in an implementation phase. And when I go to companies, big companies, but also small and medium-sized companies, they tell me we need to modernize our infrastructure. We need to get up hydrogen production. We need to really now take the steps that we need to implement what we have put into targets. And for that, we will need a massive investment program in Europe. And there, I believe we have been far too reluctant to also invest this money, not only for the economic benefit that this would have now, but also because in the long run, we know that the investment and the money that we will have to pay in the future will be much higher than what we would need to invest now.
And are you concerned now, particularly after the invasion of Ukraine, that the sort of defense priority and the spending there is going to potentially displace some of the initiatives on climate? How do you sort of manage that? There's only a finite number of euros.
Well, I think that these things actually go hand in hand, because I believe that when we speak about security, we cannot only look at this very narrow definition of defense. I mean, we'll have to invest in defense, but certainly we also need to look at how we spend the money on defense more efficiently, because right now we still very often have different member states developing different weapons systems. We have to have a more coordinated approach. While at the same time, we also have to speak about how our infrastructure plays a crucial role in, for example, our defense capacity. I've just been to Riga in Latvia and Rail Baltica, which is a big infrastructure project there. It's not only about making it possible for people to move from the Baltics to the rest of Europe, but also for military mobility, for example. So I think we need to look at these issues in a coordinated and in a way that we are using the money that we are using together for creating climate neutrality, economic strength, and also defense capabilities.
Now, I want to talk to you a little bit about the issue of China, because obviously this has gotten a lot of airtime in the last couple of weeks. The Biden administration putting up tariffs on some of the sort of EVs and other sort of parts of the renewable energy infrastructure. The EU will, presumably do the same next week. My question is, if you believe sort of China's perspective on this, they said, listen, we've been listening to what you've been saying in the West for the last 10 years. We've come up with all of this technology and bringing it to market to get the climate goals that you have asked for. So there's this question of overcapacity, but don't you need overcapacity to reach the climate goals that Europe has set out?
Well, look, I think that certainly when we look at China, we are not going to have a strategy where we cut off trading with China, because you are right, a lot of the production is happening in China right now. But first of all, this needs to happen according to existing rules, and that is something that I think is very understandable. Whereas secondly, and I think that's the strategic response that we need to give, we cannot fall back into dependencies from countries like, for example, China. In Germany, we just learned the lesson that an over-dependency on Russian fossil imports basically made us put us in a very weak position. So for me, if we now talk about how do we react to this, I mean, tariffs will be a discussion, but I think we also need to strategically look what are critical industries that we want to develop in Europe. And certainly the question of solar will be there, the question of e-mobility, battery production, and for that we will need to have the investment to develop these industries.
And you'll have to potentially be tactical about what industries Europe chooses to support, right? So for example, the solar industry, it almost seems like a foregone conclusion that Europe has said we're not really going to try to win in this one. What industries in renewable do you think Europe can win at?
Well, you see, I think also on solar industries, that was a political decision that was taken by the previous governments. We had a solar industry that was starting to develop in Germany, and then wrong political frameworks were set. So I think that right now, looking at e-mobility, certainly car manufacturers in Europe are a very, very important part of our industry, but also steel production. I live in Duisburg. We have one of the biggest steel mills. Producing green steel will be key for the future, having our own renewable energy capacities. I think there are a lot of different industries that we have to look at. And I believe even coming from the most populous and economically strongest member state, we will only be capable of doing this if we work together on a European level, because even Germany is not big enough to do that.
And on the question of who you're willing to work with for this next session in the European Parliament, if Ursula von der Leyen and the EPP were to ally themselves, say, with the ECR and work with them, would you support Ursula von der Leyen for the Commission?
Look, we have been very clear as Greens. We are not going to cooperate and form majorities with far-right or right-wing authoritarian parties. I have just told you what a catastrophe it would be for Europe to have them moving closer to power. So we are very clear. We are ready to talk. We are ready to also form pro-European democratic majorities. But if ECR or ID were to be included in this, we leave the conversation.
Well, Terry Heinke, thank you so much for your time speaking to us today on Bloomberg. Tom, I'll send it back to you in London.
I'll pick it up from here. Ollie, thank you so much for bringing us that interview as we, of course, cover the EU elections. I'm going to get some of the other news that we're watching from around the world, starting right here in Europe. French President Emmanuel Macron says Ukraine must be allowed to target missile crews inside Russia with European-supplied weapons. His comments come as Kiev's forces are struggling to defend the Kharkiv region from Russian air attacks.
How do we explain to the Ukrainians that they must protect these areas around Kharkiv if we tell them you cannot attack the points from where the missiles are being fired? In effect, we will be telling them that we will deliver you weapons, but you cannot defend yourself. So we are maintaining the same framework. We think we must allow them to neutralize the military sites where the missiles are being fired from where Ukraine is being attacked from, but we cannot allow them to pursue other targets in Russia, civilian or military.
Civil ou d'autres cibles militaires.
Meanwhile, Russia says it plans to raise taxes on businesses and the wealthy as its invasion of Ukraine puts pressure on government finances. The Finance Ministry's package would raise an additional $29.4 billion in 2025, with more than half of that coming from higher corporate profits tax, according to Interfax.
And we go to one of the other stories coming out of Asia. The National Samsung Electronics Union says it plans to carry out its first ever strike. The group of about 28,000 members announced its decision after wage negotiations with management stalled. It's the largest of several unions at the South Korean tech giant. The move adds to the challenges for Samsung as it plays catch up in developing memory chips for AI. Of course, those pressures also pressuring the stock in overnight trade. Coming up on the program, stocks to watch, including those mining giants BHP and Anglo American, after BHP said they want an extension to the 5 p.m. UK deadline today to make an offer for Anglo American. More details on that next. This is Bloomberg. Australian mining giant BHP says it wants an extension in talks with rival Anglo American to save its $49 billion takeover bid. The deadline to salvage the deal is due to expire at 5 p.m. in London today. Let's bring in Bloomberg's Clara Marquez, who is in Singapore. Clara, bring us the latest here. What does this actually mean?
So the fact that BHP has asked for an extension is not entirely surprising. We know the two sides have been extremely close, but not quite getting to where they want to be. Now, what BHP has done is very interesting. They've really laid out the concessions that they have made to Anglo American in terms of the South African assets. So this is job preservation, local ownership, all manner of issues that had been raised by Anglo are now in the public domain. The concessions are in the public domain. And what BHP really hopes is that this will be sufficient to pressure Anglo to, or at least encourage Anglo shareholders to pressure the board to grant that extension. If an extension is granted, they could have another week, perhaps more. But really, the important thing there is that we would be getting past the South African election, which is, of course, today. So you'd be getting past a lot of that heat, which has made negotiations so challenging, or at least one of many reasons that have made these negotiations so challenging.
Yeah, absolutely. The timing in terms of the politics is potentially suboptimal, as you suggest, in terms of this potential deal. What are you watching for next, then? Is it a response from Anglo? Is it confirmation that deadline, the 5 p.m. UK deadline, is pushed back? What is next in terms of how this unfolds?
Well, a couple of things could be next. I think we are very much waiting to see Anglo American's response. Do they agree to the extension, and what language do they use? The variation in Anglo's language has been very interesting. They've moved away from really criticising the valuation to criticising the structure, and that's where a lot of people are focused now. So we'll be looking to see what remains a concern for them. And of course, if they reject it again, we will be expecting BHP at that point to walk away. And remember, if they do that, they have to stay away for 6 months under most conditions.
OK, Bloomberg's Clara Ferreira Marquez on this unfolding story with the updates there. Thank you very much indeed. So from potential consolidation in the mining space to maybe moves to help consolidate within the banking space of Europe. Germany's finance minister will not yield to pleas from cabinet colleagues for more money in next year's budget. We'll get to the banking space shortly. That's according to German Deputy Finance Minister Florian Tonka. He also told Bloomberg that Europe needs to get more competitive. There it is.
I think that the crucial thing strategically, I think, is are we courageous enough to allow for banks which are operating cross-border in Europe, which are operating transnationally under a common supervisor, the ECB? Are we really allowing them to use their capital where it's most efficient, or are we ring-fencing in every jurisdiction? Then we have a fragmented banking market, and therefore we lose economic perspectives and economic opportunities.
OK, that was Florian Tonka, Germany's Deputy Finance Minister, speaking to Bloomberg's Oliver Crook in Frankfurt. Ollie has been busy. So the discussions are moving forward. Some would say still at a glacial pace because there's pushback from some smaller banking groups in Germany. But Macron clearly and Scholz are putting this near the top of their priorities in terms of making these moves. We do not have joint deposit insurance in Europe. That's one question. Cross-border transfers, cross-border mergers, there isn't the structure in place to enable that easily, at least, so that remains a challenge. And the former governor of the French central bank suggesting that the funding needs, and this is why it's important, the funding needs around things like energy transition and defence, €1 trillion per year up until 2030.
Yeah, Christian Neuer, I believe, making that comment.
Yeah.
It's fascinating, though, because I always ask this question, is consolidation a sign of economic strength on the macrosphere or economic weakness? Do you consolidate in times of recession because there's cash crunch, or do you consolidate for expansion in good kind of roaring fun times? And I think what's so interesting is that we don't really know which era we're in, but there's plenty of banking deals happening. BBVA Sabadell in Spain, Julius Baer, EFG, for example, the reported deals there, reported talks there in Switzerland. But it is still not cross-border. These are not conversations that are being had across state lines, despite, of course, the politics saying, yes, we absolutely need that.
Yeah, the cross-border component seems to still be a long ways off, even as we look domestically within and to some of those deal making.
Yeah, and so much of that has to do with kind of the macro space that we're in. Again, that's at least the micro front. I want to macro it out a little bit more because in addition to talking about these background stories of consolidation, deal flow, etc., we are still talking about ultimately rate policy and the volatility and the uncertainty that we see there. So how do you trade it? Let's bring in a true expert. Marcus Live executive editor Mark Cudmore joins us for his Markets Minutes this morning. Mark, we're dealing with a lot of news flow this morning, specifically when it comes to commodities, when it comes to emerging markets, South Africa, for example, going to the polls. There's a lot of questions about where you get the juiciest yield right now. In your view, where is that?
Yeah, it's a great question. I think it is still an emerging market yield. It's going to be a difficult backdrop because I do think that global yields still have a little bit higher to go, and obviously the Fed will be at the forefront of that. I think that, as Kashkari said yesterday, we can't rule out hikes yet, even though it's not likely. And that kind of backdrop makes it very, very tough for emerging markets because the dollar's not rolling over yet. US yields aren't rolling over. But overall, some of these emerging market yields are just extraordinarily appealing. I mean, Mexican peso has been a long-running one, but you've also got great yields in Brazil. You've got great yields in many of the Asian high yielders as well. India, Indonesia are some pretty interesting stories as well. So there are some appealing ones. And I do think South Africa is one of those ones on the list, but of course in the short term there are election risks, so maybe this is a bit more difficult in the short term timing.
An election risk of the Mexican peso as well. I believe in the next couple of weeks, Mexicans going to the polls as well there. Talk to us a little bit then about this equity market, this bond rally. In the last 2-3 days or so, NVIDIA has gapped higher, even though we're talking about this macroeconomic backdrop of potential rate hikes into the narrative, whether it comes from the Federal Reserve. Again, not the base case out of Neel Kashkari, but comments have certainly moved the market. Then the RBA. How long does the equity momentum go in the face of that narrative?
I think equity market goes a chunk higher. I think it's probably going to run through to the next earnings season. Remember, we're getting these higher yields moves because the economy is doing well overall. And the earnings season has passed off well. The data showed, like consumer confidence going yesterday, saying it doesn't look like the consumer is rolling over just yet. Therefore, the U.S. economy is not likely rolling over just yet. So I think the U.S. equity market has months of duration still. Now, it won't be at the pace it was before, and it might be a little bit more volatile, but I think that the rest of the world can even outperform in that era. So I think we're going to have generally equities do better, including U.S. equities, but I think the rest of the world might outperform. It might be a slightly more volatile period, but overall more gains to be made.
All right, Bloomberg's Markets Live executive editor Mark Cudmore taking us a tour around the world and reports. You can get more up-to-date analysis from him and the team on your Bloomberg terminal. All you have to do is type in MLIV Go.
OK, let's cross over now and bring in Joe Easton from our stocks team to see what Joe's looking at. Joe, what is standing out to you today?
Morning, Tom. So we've got to start with BHP and Anglo American, with the Australian company announcing earlier today that it is looking to extend that deadline. We had been waiting for that clock to be ticking today to 5 p.m. That was the deadline for them to make a firm bid for Anglo American. Now, BHP, as Clara was explaining a few moments ago, has actually made some promises to fix some socio-economic measures that were among the concerns by Anglo American. So perhaps that will help this deal get over the line. Here's some key points from the screen. As I said, it was the 5 p.m. today deadline that we're waiting to be extended. Now, what's interesting for me is the price of this deal. Now, it is an all-share offer that was announced last week, the extended offer, and it's worth around £31 per share based on the calculations that we've done. But we can see the stock of Anglo American only trading at $25.58 at the moment, massively below the potential bid price, suggesting some people in the market don't actually think this deal will go through. Some execution risk. As I say, Clara was explaining some of the details in that one. That might, though, actually be positive news for BHP, because we can see on the screen here this stock down 13% this year, suggesting BHP's own shareholders don't actually like the terms of this deal. But we'll wait to see if we get confirmation of that one extended today. Then we're over in renewable energy. Siemens Energy announcing some big potential job cuts to come, according to a Bloomberg report. Now, it would be as much as 4,100 jobs, according to the Bloomberg update. Now, that follows a report out of a union yesterday. A trade union said that they did expect this to be announced. Potentially, we could see losses over in Denmark, Spain and Germany as well. And this comes amid spiralling issues in the company's turbine business, including some defective wind turbines, which has been a big weight on this stock. Now, I love this chart because it really shows you Siemens Energy massively underperforming the broader Stock 600 energy index, kind of showing you that this is a very company-specific stock price underperformance. We can see it dropping as much as 70% at the low in November last year for that company. Now, if we bring up the 4-year chart, we can see that it has actually started to recover, and it actually trades above where it was when it span off from the main company, Siemens, around 4 years ago. So that one potentially is going to be a mover today. Then we've got airlines. It's negative. It's American Airlines. They've dropped around 6% last night following their earnings upgrade. They've downgraded their guidance for pricing. That seems to be the issue. So although some of the profits weren't too bad, it was the pricing, suggesting transatlantic and long-haul pricing is going to come down. Good news for travellers, not good news for airlines, and potentially not good news for the likes of IAG, Air France and Lufthansa, the main long-haul companies that we look at in Europe. I'll be looking for a read across on those stocks at the open this morning.
Great stuff. Joe Easton from our equities team, thank you very much indeed for some of the stocks to keep an eye on at the open. We are 6 minutes, just shy of 6 minutes away, of course, from the European Open. Kriti, futures just pointing down by just shy of 0.1%. US futures, though, also looking lower by 0.4%. The Nasdaq breaking through that fresh record yesterday.
Yeah, we're going to keep an eye on the kind of the macro read-through. Joe there was talking about some of the individual stories, the BHP deal, the airline story. We're going to keep an eye on the big oil majors as well. You are starting to see a little bit of volatility in Brent crude, trading at about an 84 handle. Is there then a read-through into your BHPs, your BPs, your Shells, your Totals, etc.? We're going to have full coverage for you next. This is Bloomberg. Welcome back to Markets Today. We're a few minutes to go until the start of cash equity trading. Futures are pointing a little bit lower, but I think when we're looking at some of the individual moves, we may get a little bit more volatility. We've got our eye on a couple of stories here. BHP Anglo, of course, is top of mind. Do we potentially see, with this extended deadline, does BHP trade higher on it, perhaps, simply because of that traditional M&A flow? Or does the volatility actually become more of a weight?
And as Joe was pointing out, BHP is down around 13% year to date, so they're looking to push back that 5 p.m. deadline today. Yeah. Their board, the two boards clearly in conversation, the $49 billion valuation of that deal. But again, the key focus on the restructuring around the platinum and other assets that Anglo has in South Africa. Big day, of course, there with the elections. So, of course, you're currently looking, as we count down to that open, there's losses of 0.2%. Would you put any money to play ahead of the PCE index on Friday out of the US? How consequential do you think that's going to be?
Well, probably more consequential for this bond market, which rallied, I think, something like 10 basis points just overnight. So we're looking at 455 on the bond market. But there are some sectoral stories that we're going to have to get through before we get there. Oil, of course, is one of them. We've got reports of some potential consolidation out of ConocoPhillips, Marathon Oil. We're going to dive into the detail. Massive deal, if it is indeed true. Remember, still reports at the moment. The story of consolidation is very, very important in the States, as is the airline sector, we should mention as well. American Airlines overnight cutting their profit outlook. Do we see a read-through in the likes of IAG, Lufthansa, etc.?
Yeah, some of those airlines called low on the back of that news out of the US, so that potential read across. The geopolitical risk as well around oil, to what extent is that priced in as we look at, of course, Israeli forces in the centre of Rafah, and then Red Sea, and a reminder of the attacks that continue there by the Iranian-backed Houthis. Of course, Brent currently called up 0.3%, $84. WTI back above $80 a barrel. 4 seconds away from your market open this Wednesday.
Yeah, tons to watch. We are officially open on the UK in the FTSE 100, of course, and right out the bat, you are getting some early indications in the oil space. BP, for example, right out of the gates, one of your biggest index contributors to the upside. We're still waiting for some of the other trades to shake out, but it looks like your utilities, one of your biggest index downsides is National Grid here, and that's an interesting one. We've been monitoring the utility story, of course, out of that company.
Yeah, we're looking at BHP as well on the back of that story. That is currently gaining. I'm just trying to get the price action on BHP, of course, looking to push back that timing around the deal, 5 p.m. for Anglo. Currently up 1%, a little over 1% in the session. Just a couple of seconds in, of course. Across the benchmark, you're still down 0.2% as the futures had flagged. Sector by sector, and of course, Kriti, you were touching on some of these. Just breaking down the sector story then with the focus on the energy markets. You called it energy, the leading sector, at least in early doors, right now up 0.6%. Tech also getting a modest lift, just up a shy of 0.1%. Of course, Nvidia gaining 7%. yesterday in the US. So we'll look at the read across to the semi-space here in Europe, the likes of ASML and Infineon in focus. That 7% gain for NVIDIA, lifting the Nasdaq to a fresh record, though futures around the Nasdaq pointing to a bit of profit taking maybe today.
Yeah, just to lift the hood on that a little bit as well.
Yeah.
You were talking about that tech. ASML higher by about 1%, index contribution about 14% of the stock 600. But to me, it's still the commodity stories that taking the cake here. Shell, Total, BP are some of your biggest index contributors, as is, by the way, SAP is kind of buried in there as well. So there is that big tech read-through in there as well. We should mention, though, when you talk about the NVIDIA read-through from the last 5 days, it has gapped higher twice from a technical standpoint, which I know a lot of Europeans frown at on this side of the Atlantic. From a technical standpoint, when you gap higher once, you tend to see a little bit of a pullback. Gapping higher twice, it feels like is testing fate to some extent. Look at the European read-through, though, and that doesn't seem to be true.
And not unusual to see $100 billion market cap moves on NVIDIA on a daily basis. So as you were saying earlier, they've added $470 billion to their market cap just in the last 4 days, with a market cap now of just shy of $3 trillion US. Still, of course, behind Apple and Microsoft, but catching up fast. So the Post Office, Royal Mail story, that continues to be in focus in terms of the gains coming through for IDS, up 3.3%. Safe Store also gaining 2%. Renault, one of the car makers, of course, listed over in France, up 2%. On the downside, you've got Anglo now off by 2%, at least so far. Grifols also taking a hit, off 2%. Anglo 2%. Down, BHP getting a bit of a lift of about 1% as we continue to watch the details on that deal.
Yeah, we should mention, and of course we are setting ourselves up for plenty of volatility in the days ahead and in the hours ahead as we get perhaps a little bit of a read-through and commentary from Anglo as well. We should mention Siemens Energy as well, which is one of the stocks that Joe flagged, given their kind of cuts in terms of labor force. Those shares taking a hit about 0.5%, despite usually when you see those quote-unquote efficiency cuts from layoffs, the stock actually benefits today. That does not seem to be the case.
Essential cuts of around 4,000 on the headcount. You mentioned ASML, so up 1%. We'll get more details in terms of a view on the AI story then, because ASML, of course, providing the equipment with which you need to be able to crunch out these very, very sophisticated AI chips that NVIDIA, of course, is benefiting from. And the story around AI remains a key catalyst for many within these markets. We've seen the read across. Some, though, are suggesting there's a bit of need for scepticism. Take a listen.
This solid consensus only a couple of years ago that cryptocurrencies were going to change everything. And then suddenly that consensus just goes away. So I think right now there's way too much confidence about the future trajectory of AI. I promise you when we talk in 2 years, we're going to look back and say, yeah, it really was a bubble. We overestimated where it was going.
I promise you we will look back at this as a bubble. Paul Romer, Nobel laureate, former World Bank chief economist, speaking to Bloomberg. Let's get another view now and bring in Anika Gupta, director of macroeconomic research at Wisdom Tree. Anika, good morning. Are we putting too much weight on the AI catalyst for these markets?
A very good morning, Tom. Undeniably, NVIDIA's results was such a big game changer for the markets. It hasn't yet, helped permeate through the broader market. What we're seeing is a very large divergence playing out across U.S. equities, where the tech-heavy Nasdaq continues to outperform, but the broader S&P 500 is actually lagging in performance. So I think, the strength of NVIDIA's performance is clearly tilted mainly to those growth-oriented sectors, while the rest of the equity market continues to be plagued by this theme of rates remaining higher for longer in the U.S.
Do you need to adjust, Anika, on the rate story, switching focus, but of course rates ties into to the tech story to some extent. Do you need to readjust your portfolio? Do you need to be at least putting some hedges in place around the prospect, the potential prospect, even if it's an outside chance of a rate hike that was flagged by Neil Kashkari? He says it's not the base case, but again, he's putting it and saying it remains on the table.
Well, I think those hedges do definitely need to be in place. I think the theme in the equity markets today is really about tailored monetary calibration, given the fact that each of the countries have such a different play out of their output gaps versus their underlying performance in the economy. And hence, if we look at it, you have the ECB and the Bank of Canada likely to go ahead with their first rate cut next week. However, expectations of rate cuts by the Bank of England and the Fed have been pushed back. And hence, it's very difficult to take a rate hike off the table for us at WisdomTree, we are adopting a very low probability to the possibility of a rate hike. I believe it would be a policy error given the fact that we are seeing some weakness, seep in within the labor market in the US. We are seeing a bit of a slowdown in some of the economic data, and hence, our view is we are likely to get a rate cut. And now it's really a question of whether we get those 2 rate cuts for 2024, or it just boils down to just 1 rate cut for the US economy.
What is the read-through there? Should we be more worried about the international read-through in terms of a divergence between what's going on in the U.S., this continued resilience, this continuing talk of a potential hike, at least from a market's perspective, and then on the other hand, almost doubling down on the cuts narrative in the ECB, in the BOE? How concerning is that divergence?
It is quite concerning, and I think it's likely to play out quite aggressively across the FX markets. Take, for example, the euro has been quite resilient, even in the face of, the expectation of rate cuts to begin, and the expectation of a total of 3 rate cuts to be, executed by the ECB. However, the euro has remained quite resilient, and I think that's largely because the economy has been turning around a corner. We've seen some stability in a lot of the macroeconomic data prints. Now, that being said, it's very unlikely for the euro to hold that strength in the face of a much stronger dollar, given the fact, as you pointed out, Kriti, much stronger economic data coming out of the US in comparison to the rest of the world, and rates, that yield differential with rates remaining a lot higher, that's going to favor the dollar over, the euro for sure.
Is there such a thing as too strong of a dollar? And I say that with a little bit of sarcasm here, given that the market is still net long the dollar. I'm concerned about whether or not that positioning is accurate, despite the fact that that dollar, the economic strength, can only last so long if the rest of the world is seeing weakness.
Absolutely. I mean, it comes back to the all-important question of fiscal stability. There have been, plenty of concerns and warnings on the U.S. fiscal stance. How stable is that, and how it's going to change given the elections, coming into focus now. So there is that, when you try to weigh the pros and cons, you have much stronger economic data, but it's come alongside a tremendous amount of debt burden, and obviously that raises the question of, is this growth likely to continue to remain stable? How long can the U.S. continue to expand its fiscal balance? And I think that's the key question. If that growth continues to come in, that will just keep the dollar a lot stronger. However, if that growth begins to come in a lot more of an anemic way against a ballooning, budget deficit, that's when I think, there will be concerns on the strength and stability of the dollar.
Anika, the Bloomberg Commodities Index is well off its highs of 2022, but year to date it's up 8%. It's been grinding higher. Are we underestimating the potential inflationary impact globally of higher commodity prices?
I would definitely say we are. 2024 has really been the year of the metals. Across metals, be it industrial metals or the precious metals, they've both gained, in the face of these expectations of rate cuts, alongside, very long-term themes of the energy transition, which is very metal intensive. We've also had concerns of the AI, the AI frenzy requiring tremendous amount of power, and that power is again falling back on commodity resources such as copper, which is a highly conductive metal. And this is just, spurring a lot of demand for these industrial metals. I think the story in 2023 was those supply deficits still remained intact. However, there were concerns of a China slowdown, and that just weighed down on sentiment. What's happening in 2024 is you're having improving economic data from China, alongside the fact that these supply deficits continue to grow. And I think that's become, the new wake-up call for investors that, yes, we do have supply deficits intact for these metals. The demand still remains strong, and Chinese economic data is improving. And that's really triggered, that strong price performance for metals, both in the precious metal space as well as industrial metals.
Yeah, on a day when the IMF upgrades its forecast for growth out of China from 5% or from 4.6% to 5%. When it comes to the election story in Europe, Anika, do you start to think about, do you start to price in, do you start to adjust for maybe a ramp up in fiscal spending from the European governments on the back of this election that comes through, if there's a shift to the right? How do you think about the politics of Europe and how that ties into your investment decisions when it comes to European stocks?
Yeah, that's a really pertinent question, Tom. We have the elections coming out in the first week of June. Clearly, the polls are indicating a strong shift to the right. And clearly, the top focus remains immigration. The big concern is how we're going to see the EU deal with the crisis of immigration alongside the climate crisis. I think fiscal budgets will have to be expanded slightly. We've seen that already take place in countries such as Italy as well as Spain. And I think, so far what we have seen is the fiscal spending is likely to shrink. However, I think looking ahead, if Europe is very serious about the energy transition, if they are very serious about, tackling all of these crises that Europe is facing, I think they will have to, pull those purse strings a lot further.
Anika, you mentioned Spain, music to my ears. We thank you so much for bringing us that crucial context, doing a little bit of a tour around the world for us. Anika Gupta, their Director of Macroeconomic Research over at WisdomTree. We thank you so much. I want to get a quick check on the Sensational Six. Guy isn't here, so I'm going to put my Guy Johnson hat on and really show you this kind of tale of two heavyweights, because you're only mover to the upside is ASML here, higher by 0.8%. That likely an NVIDIA read-through. But look at the rest. LVMH in particular taking a beating here. And I'm curious if that's simply just a read-through from the red on the screen we saw in the Asian session. The rest, your Novo Nordisk, Ferrari, Schneider Electric even, not getting in on that AI trade. Traditionally, we tend to see Schneider Electric, even though it is a utility, get some sort of that AI read-through. Not this morning. And, of course, Nestle down 0.3%. I want to get a check on some of the other individual stocks on the move. Joe Easton is here with that story. Joe?
So we'll start with the UK deals, Kriti, and it is actually showing us a pretty clear story here. Anglo-American coming down around 1.2%. BHP actually edging slightly higher now. BHP requesting an extension to their deadline to make a formal bid for Anglo-American, and perhaps some people in the market starting to price in less of a chance of this deal going through, with Anglo coming further down. Bear in mind, we said earlier that this deal was priced at above £31 a share, and Anglo's only trading at 25. So what does that tell you about the chances of this going through? Then in terms of another one trading massively below the takeover price, IDS Royal Mail, the company, announcing that it is backing a takeover from the Czech billionaire Kriti. That was in a statement that hit the wires today. But the deal is at 370 pence a share. It's only trading at 330. The issue here is, would the UK government likely block this deal if it did actually get to a shareholder vote? That is the view from analysts. With the Labour government potentially coming in, it would make this deal even less likely. We've got IWG down the bottom here. Now, this is the owner of Regus, the shared workspace business, bit of a WeWork competitor, a long-term investor offloading a chunk of stock in that one today, and that one is dropping at the moment. We'll take a look at some airlines, though, because I did see some moves lower in at those stocks. There we've got a couple on the screen here. Actually, we've still got a couple of the other ones there. We've got the miners back on the screen there. We'll try and get that fixed. But I have noticed that we've got some airlines moving. I saw them on my screen. You'll have to take my word for it. We saw IAG, Lufthansa, and also Air France KLM dropping around 2%. Actually, some of the worst performers today, because we had news of American Airlines downgrading its earnings forecast last night. That stock fell 6%. It's the long-haul sector that seems to be seeing the weakest pricing at the moment, according to analysts. The airlines are getting hit. We are going to look at some oil stocks, though. We did see some gains in BHP. There we go, BP, Shell, Total Energies, Equinor. Now, a couple of bits of deals news from the US. ConocoPhillips and Marathon Oil potentially tying up, according to the Financial Times, in a massive merger that would possibly take place. And we did also see a shareholder vote on Hess being taken over as well. So a couple of deals moves, and also the higher crude prices feeding through into a couple of those stocks today. We got BP, Shell, Total Energies, Equinor, all up around 1% this morning. Then we'll just quickly bring you some morning calls. Renault, now this one is upgraded at Goldman Sachs. They recommend you should be buying. It always reminds me of Thierry Henry and Baba Boom, that old-fashioned advert. But Goldman reckons you could buy because they got 10 new cars coming out over the next 12 months. There's a lot of new vehicles, and Goldman likes that one. Finally, time to book your summer holiday last minute, maybe on the beach. This one is upgraded at Berenberg. As the company says, life is better on the beach, and that one is up 2%. Berenberg thinks that the appetite for holidays will not wane despite the ongoing cost of living crisis. They like that one, and it's up 2% this morning.
The chances of Thierry Henry actually driving a Renault are pretty slim, aren't they, Joe? They're about as slim as you driving a Renault.
Well,
I know you've got the Maserati parked outside, Joe.
Yeah, it's next to Kriti's Aston Martin.
There we go. It's in prime position. Joe Easton, thank you very much indeed. Also thinking about his beach holiday. Joe, thank you for the touching on the stocks to watch. I'm being told to tease on. The producers have had enough of this, Joe, but not enough of you, which is important. Coming up, BHP asks for more time to discuss its $49 billion takeover bid for Anglo American. We're going to get more details on that next. Stay tuned for the latest on what could be a mega merger, of course, in the mining space. Lots of details, lots of caveats still to unpack. This is Bloomberg.
This is Markets Today. We're about 20 minutes into the European trading day, decidedly lower day that we are seeing. Perhaps a little bit of a read-through from the Asian session as well. But again, only lower by about 2 or 0.3%. Not seeing a major move. Where you are seeing major moves are in the individual names. And we want to go to our top story this morning. Australian mining giant BHP saying it wants an extension in talks with rival Anglo American to save its $49 billion takeover bid. The deadline currently set for 5 p.m. in London today. All over the story, inundated with news in the morning, is Will Kennedy, Bloomberg Senior Executive Editor for Energy and Commodities. We appreciate you making time for us this morning. Walk us through what this means. BHP asking for an extension. An extension for what?
Well, they had said that they wanted to buy Anglo American, and under the UK takeover rules, you have a certain amount of time to either make a deal or walk away for 6 months. We had one extension a week ago. We're about to hit that second deadline this afternoon. BHP is obviously still keen to acquire Anglo American, but the sense we get is Anglo American is being resolute in saying that the deal doesn't work for them. Their reservations are less about valuation and more about the deal structure, which involved the divestment of 2 South African subsidiaries, one that mines platinum and the second that mines iron ore. And BHP says that that part of the deal can work. There's a plan. Anglo Americans say that it can't, that it's a big impediment to the deal, and that BHP hasn't been able to reassure them that they can get it done. So they seem some way apart, and this is BHP basically appealing to say, let's carry on, and hoping that Anglo shareholders might put pressure on the Anglo management team to talk some more.
So it's more about maybe putting pressure on those Anglo shareholders rather than suggesting that BHP can soften some of those demands around the structural changes. Is that our read at this point? And the two boards have been talking.
They've been talking. I don't think the 2 companies have been engaging over the last week, as they said they would do. Yeah. Our sense is that those engagements haven't been particularly full on. And to your point on structure, I think BHP has tried to make clear throughout they think its structure works, and that they're just trying to convince Anglo. One concession they do seem ready to make, according to our reporting, is perhaps to introduce a big break fee into negotiations as a statement of intent. But so far, Anglo American management seems unmoved.
All right, so we're going to keep an eye on that and any kind of headlines that we get going into the 5 p.m. deadline today, whether Anglo pushes that. It's not the only place we're seeing potential consolidation here. We're seeing it in the oil space as well. Some reporting coming out of the FT here. ConocoPhillips in advanced talks to buy Marathon Oil. Now, for our friends on this side of the Atlantic, why is this deal valuable?
Well, Conoco has been, it's part of a broader consolidation trend that we've seen within the US oil sector over the last year or so, that people are starting to get bigger to drive down costs to acquire other shale producers, especially to drive returns. And Conoco has been part of that trend, buying a company called Concho Resources, for example, and Shell's shales asset. And so Conoco is clearly keen to bulk up in its US production, and buying Marathon, which has assets in several US fields, and is a 95% a US producer, would enable it to do that. And then the bigger picture is big deals throughout the sector. We saw Hess vote to sell itself to Chevron yesterday. Exxon acquired Pioneer, one of the biggest shale producers. So it's very much set within that trend, and about Conoco trying to give itself the heft to compete in the space.
Is this kind of reverting to norm for the energy space in the US in terms of it became quite bifurcated and fractured around fracking, and now there's consolidation? And also, do the regulators just sit to one side on these deals? They just let these go through?
On your first point, I think that's right. The shale industry was obviously not driven by the oil majors. It was driven by the independent producers, the pioneers, etc. And what we've seen in the last few years is the majors come into the space and make it part of their future, their growth plans as well. And we've seen that through the Pioneer deal and the others that I mentioned. I mean, regulators seem pretty relaxed about oil deals on the whole. On the upstream side, it's not as if companies tend to restrict production to try and drive up the price. People pump as much oil as they can typically. So they haven't, and you know, they would argue that they will also drive down costs, which may ultimately feed through to consumers. So there hasn't been a lot of attention among regulators, although they did intervene a little bit in the Exxon Pioneer deal to deny a Exxon board seat to the Pioneer founder. But on the whole, yes, they're pretty relaxed about this kind of deal.
OK, really fantastic context. Will Kennedy, thank you very much indeed, of course, leading our energy team on that deal around ConocoPhillips, of course, and Marathon, and getting us up to speed on the developments around BHP and Anglo as well. Switching focus to the airline space, and there's a read across also when it comes to what's happening in the US, with American Airlines cutting their outlook yesterday, the profit outlook being cut. And the read across then to European airlines, and you can see the hit coming through because American Airlines took a big move lower, down 6%. It ended lower, more than 6% on the back of that news. And European airlines also feeling the pressure as a result of that. Continued concerns, obviously. IAG down close to 3%. As you can see, Lufthansa down in Germany, down almost 2%, and Air France off as well by a full 2 percentage points right now.
Yeah, it's interesting it's coming at a time when they're also talking about record summer demand, historic summer demand that they're trying to capitalize on. But they're saying, look, these high costs are simply too high. It comes from jet fuel. It comes from wages. Remember, a lot of these airlines in the States have been negotiating in wage negotiations with pilots, with flight attendants, even with air traffic controllers. So this kind of read-through is having a real effect on really being able to capitalize. That doesn't even include the capacity restraints you have right here in Europe.
Yeah, and Ryanair and EasyJet as well, suggesting they don't have a lot of clarity in terms of summer pricing. Ryanair, in fact, seeing slightly softer pricing in that crucial summer season. Coming up, polls open in South Africa's crucial election. We're going to take a look at the embattled economy and why there are concerns around a potential coalition. This is Bloomberg. Welcome back. Now, Israel's army says tanks have reached the centre of Rafah. And according to the AFP news agency, residents have been reporting clashes between Israeli and Hamas forces in the centre of town. The White House says it does not support a major ground operation in Rafah, but has yet to see Israel cross President Biden's red lines. Let's get more on this story with Bloomberg's Horizons anchor, Jumana Basechi, who's in Dubai. Jumana, what is the latest then on the ground?
Yeah, the latest is that the Israeli tanks have started rolling in closer to the center of Rafah. The Israeli Prime Minister Netanyahu has long said that this ground offensive is needed in order to weed out the last of those Hamas officials. But of course, the backdrop to all of this was that deadly airstrike on the Rafah camp over the weekend, killing up to 45 Palestinian children, women, many of them included. But of course, per Israel documentation, they also took out 2 senior Hamas officials. And key to that was whether or not the U.S. administration saw that attack on Sunday as a crossing of that so-called red line. And I think it was interesting yesterday to get commentary out of the White House saying that no plan is expected to be changed on the back of this. They do not deem Sunday's attack to be one that has crossed the red line, and namely because on Monday afternoon, the Israeli Prime Minister came out and said that it had been a tragic mistake. The IDF said that they had used small munitions that wouldn't have been capable of setting off the blaze that then engulfed that encampment, and an investigation is ongoing. But of course, the longer this incursion into Rafah goes on, the more international condemnation Israel are getting, not necessarily from the US, but from Europeans, as we spoke about. President Macron on Monday tweeting that he was outraged by the events that occurred in Rafah, and even very strong criticism from some Arab countries. Saudi Arabia yesterday, the Foreign Affairs Ministry referring to, and this is a quote, genocidal massacres. So very strong wording coming out of Arab countries here. But ultimately, it seems as though Israel are going to continue with this ground offensive so long as the U.S. don't seem or see Israel as having crossed that red line. And so far, in their eyes, they haven't.
And on top of that, when we talk about the humanitarian aid, the $320 million pier that the United States military had built, also seeing some infrastructure issues delaying some of that humanitarian aid to get onshore. Bloomberg's Horizons anchor, Shumana Bersachi, we thank you so much for that crucial context. We want to stick with some of the top stories around the world. On top of the agenda as well is in South Africa, where voting is well underway in one of the most consequential elections since the end of apartheid. On the ground, Bloomberg's Jennifer Sabasacha, our South African correspondent, is in Durban, a city where the vote could be won or lost for the governing ANC. Jen, walk us through the key battlegrounds here.
Yeah, that's right, Kriti. I mean, we're paying attention, very close attention, to three key battleground provinces. There's Gauteng, which is home to Johannesburg. There's the Western Cape, home to Cape Town. And also, as you mentioned, here in KwaZulu-Natal, which is home to this city, Durban. And I want to zero in on Durban because there is a reason why we are here. It is very significant for a number of reasons. Within KwaZulu-Natal, it has one of the busiest ports, the busiest port in sub-Saharan Africa. But also, it could be a very interesting split in terms of what we see out of the outcome of this election. And really, the split could come from the urban voters here in Durban and also the rural voters. And it's not just that. It's also that, you know, KZN has also been for a long time an ANC stronghold. I don't know if you can see a lot of the people behind me are ANC voters. But two former ANC members who formed two new opposition parties are really posing a real threat to the ANC. And so the question is, are they going to be able to split up the majority vote that the ANC is seeking, that they've gotten for the past 30 years? And what could that potentially look like? And so that is really why we're focused in here on Durban in particular.
Jen, what is the nervousness, the anxiety around a potential coalition on the back of this election?
Right. It's interesting, Tom, because if we think from an investor perspective, they've taken a look at a lot of the local municipalities and provinces here that have been run by coalition governments, and there has been instability. And not just that, it is interesting when you take a look at just the makeup of the opposition parties and what a potential coalition could look like if we do see that from the ANC. And so just a few weeks ago, I actually spoke to the second most senior member of the ANC who gave us his perspective on what potentially a coalition could look like if the ANC were to partner up with one of its former members. Take a listen to what he said.
We need to consolidate that base because we trust it. But you also focus on provinces where there is a risk. Many say in KZN will be troubled by MK, which just won a case against us now in court. Okay, and I'm saying to them, that is not where the threat comes from. The threat comes from the AFP.
You don't think the MK party is going to be a threat to
it
the
is
ANC?
Going to be a nuisance. But but the threat is coming from IFP in KZN.
So that was Gwede Montashe there. Speaking about the MK party, I mentioned two former ANC members, one of them being former President Jacob Zuma, who is the leader and the face of the MK party. And I mentioned the split between the urban and the rural voters. KZN very much is where Jacob Zuma's support comes from. That is where his support has always been. And so if there is to be a coalition, would we likely see the ANC team up with some of these former members? What would that look like? And would there actually be stability, especially considering on the local level, we haven't been seeing that much?
OK, Bloomberg's Jennifer Dabasaja on the ground in Durban on, of course, an historic day for the people of South Africa. Jen, thank you very much indeed. We'll stay on this story and dig into the economics of South Africa now. Bring in Yvonne Mahango from Bloomberg Economics with that expert lens. Mahango, Yvonne, what is at stake then for the economy in this election for South Africa?
Our reform momentum is at risk. We've had several years of the government investing in power infrastructure, renewable energy, trying to ease the logistical challenges, and we're just beginning to see the fruits of those investments. If the ruling party loses its outright majority and are compelled to seek coalition partners, we could see a change in that trajectory.
Yvonne, walk us through the market reaction here. I'm really interested to see that ahead of this election, you actually saw very strong demand in the bond auction yesterday. Some saying that that's just simply a function of the yield, but even compared to previous South African auctions, this was particularly strong. What's the logic there?
I think part of the reason is that many investors are expecting a favorable outcome because although the ruling party may lose an outright majority, comparing it to form a coalition government, the policy direction shouldn't change because the policies of the main parties are broadly similar. Their priorities may differ, but policy shouldn't change. And I think that's given investors some comfort. In addition, South African assets tend to be undervalued, and I think that's contributed to the continued interest we've seen that's contributed to the rand strengthening into the elections.
And it feels like the idea of just continuity is obviously going to be the favorable outcome for the rand, as you mentioned. But I'm curious what kind of throws a wrench into that. If you do see a coalition government, if you do see a little bit more of a central driving force from the government in terms of nationalizing mines, for example, or nationalizing certain parts of certain countries, how is that translated into the rand and, of course, the bond market as well?
So first, I should highlight that's a low probability outcome. So that's the economic freedom fighters that is suggesting or proposing those reforms. It's unlikely the ANC would seek a coalition with them. But naturally, if we were to go down that road, of course, the currency would take a hit. We'd see investment inflows slow into the country, borrowing costs would increase, and we'd see growth slow going forward. But I should point out that is a low probability outcome.
Where are we, Yvonne, on investment flows into South Africa? And to what extent is that going to be important in terms of driving this economy forward in the months ahead?
So, of course, going to the elections, we've seen investors generally be underweight, particularly on the equities front. But going forward, we do expect that to pick up, particularly on the foreign direct investment side, on the back of the ongoing reforms that we're seeing. And that's, of course, assuming that the momentum does continue going forward. If we look at our trajectory in terms of our base case scenario, and that's policy being sustained, we do see growth picking up over the next couple of years, returning back to the long-term average of 2%. And that's on the back of a pickup in investment as the business landscape improves in the country.
Well, in terms of the business landscape, this is coming in the background of years of questions around corruption, for example, these rolling blackouts, et cetera. Mm-hmm. How do you get that investor confidence, even in a new government? How long might that take when it comes to credibility that any investment in South Africa is actually safe and maybe not worth the risk premium that you're seeing in the bond market right now?
That's a fair point. And I think if we look at the coalition scenarios, you find that investors' preferred coalition partner is the Democratic Alliance. They're the party that promotes itself as being pro-business. They're likely to place the country back on to fiscal health a lot faster than any of the other coalition partners. In that scenario, I think you'd see investment return to the country a lot quicker, and corruption being tackled more than we've seen in previous years, allowing for a bigger pickup in investment inflows.
Yvonne Mahongo from Bloomberg Economics, connecting the dots for us, of course, on a crucial day for South Africa. We thank you so much for that context and analysis this morning. Coming up on the program, we take a look at the markets following Minneapolis Fed President Neel Kashkari's comments on the potential of a rate hike, maybe not being ruled out just yet. We're going to dive into the details and what that means for the trade in the bond market. Stick with us. This is Bloomberg.
I've been asked many times, would we take potential interest rate increases off the table? I don't think anybody has formally taken them off the table. Even me, I say that we could sit here for as long as necessary until we get convinced that inflation is sustainably going back down to our 2% target. I'm not ruling out potential interest rate increases from here, but I think sitting where we are for an extended period of time is a more likely outcome. But of course, if we get surprised by the data, then we would do what we need to do.
Minneapolis Fed President there, Neel Kashkari, talking about the potential for rate hikes, basically saying all options are on the table. You can't rule anything out. They are data dependent. It's also remember to keep in mind he is not a voting member on the FOMC at the moment. What does that, though, mean for the trade where in the last 24 hours, the bond market moved 10 basis points higher on the 10-year yield? We bring in Bloomberg's Justina Lee for a little bit of insight. Justina, a 10 basis point move on the possibility from a well-known hawk that a hike may just be on the table. How do you play this?
Yeah, I think it's interesting because I think what he was kind of echoing is sort of what we saw in the Fed minutes last week, right? Which is that some Fed officials think rate hikes are still possible. Now, the reason this was so disappointing to markets is that before that, Jerome Powell actually told markets at that same meeting that that was probably not going to be the case. And I think a lot of traders took comfort in that. And so now that is in a way kind of going back against kind of this more bullish trend that we've seen recently.
And we've already seen that division within the FOMC. Michelle Bowman, Loretta Mester, even though I think she's on her way out as well when it comes to the voting policy. And then adding Jay Powell. Guy Johnson loves to ask, is Jay Powell representative still of the entire FOMC? How do you trade, again, the bond market in the face of that division? Is it just more of a question of a floor in yield as opposed to a ceiling?
Yeah, I think that, is a great question. And we've kind of also have these kind of contradictory economic signals here, right? I mean, consumer confidence kind of came in pretty strong, even after, a period of actually cooling economic data. And so I think we're kind of seeing kind of very, very much clashing trends here. And all eyes will be on kind of the key inflation data coming up this week.
Yeah, and we'll get to that. But to your point, the consumer confidence survey is really interesting, wasn't it? Because it seems to be those who have exposure to the stock market are feeling a little bit more optimistic, so high net worth individuals. Those at the lower end who don't have that exposure feeling that things are tougher. And then the expectation that there's an increased risk of recession as well, and that came through from the survey. To what extent is the PCE then, the Personal Consumption Expenditures Index, that comes out on Friday, to what extent are the risks asymmetric or symmetrical when it comes to that data point? To what extent are the markets at risk as a result of what is expected to be an inflation print that comes in line or at least gives the Fed some comfort?
Yeah, I think currently people are expecting that it will kind of further add to recent evidence that inflation is indeed cooling. But I think what you've kind of heard from a lot of the Fed hawks is that, they're not just counting on one print, right? They want to kind of see a series of prints showing that inflation is indeed cooling. And of course, kind of lower than expected would be helpful. But it kind of feels like it might not be sort of entirely sufficient to really turn the tide here.
Yeah. So we'll see. I mean, yeah, they need a number of months. Our previous guest on the show saying they're pushing back their expectation for the Fed and the first cut until December. We've got fewer than 2 cuts priced in by the markets. We have the dot plots, of course, that come through with the next meeting and the revisions there. How important is it if we go from 2 to 1? We're at 3 now. The dot plots, the forecasts are for 3. Clearly, that's going to be revised. That seems to be what we're hearing. If you put Jay Powell to one side, at least, the dove in the room, as some might argue, It seems like you're going to go from 3 to 2, or do you go from 3 to 1?
Yeah, I mean, I think those will be really big moves because in a way, I think the markets all year long, they've kind of been a bit on the dovish side in that they're very willing to believe whenever we get any dovish signal. So I think if we kind of get anything hawkish here, it will be kind of a pretty big shock to the markets. And one thing is interesting is that I think we've kind of heard a lot of signals from Fed officials lately that, they're not just looking at the cyclical factors. It does seem possible that a lot of structural trends have turned to the extent where maybe the neutral rate of interest, the interest at which the economy is sort of just kind of neither growing nor shrinking. I mean, it seems like that has actually structurally shifted higher.
In terms of kind of putting your money where your mouth is, you cover quants very, very well. There's a trade, or a story, I should say, from a quant fund, Catalyst Quant Fund, that is officially shorting 10-year treasuries. I imagine that they're not alone. But what stood out about this particular fund is that they beat most of their peers, 94%. They have about $7 billion in assets, getting a return about 14% this year. What struck me is what their CIO said. It's not clear how you can get rates down without getting inflation back up. And I'm curious how much of that sets the precedent for the ECB, the BOE, et cetera. If the Fed is in this kind of conundrum where things are almost too good to be true, how does that have ripple effects?
Yeah, and I think, it's interesting because maybe Europe is sort of more confident right now that they can go ahead and cut rates. But I think what we're kind of seeing in the U.S. is there are a lot of supply side factors coming in as well. And so those are maybe kind of a little bit less within the control of central banks. And kind of what do you do in the face of that? And of course, with the ECB, can you afford to diverge from the Fed now that it's looking like that's going to happen this year?
Is it, given the Treasury auction and the lack of demand that came through, so the weakest demand in over a year for the 5-year, $70 billion issued by the Treasury yesterday and coming in yields up above the pre-auction price, is that a canary in the coal mine for these markets, or do we look past it?
I think Europe is going to be quite a different story, so maybe we kind of do look past that, yeah.
OK. All right. Thank you very much indeed, Justina Lee, on the macro and the Fed story and how that's being read across into the markets, of course, as we look ahead, of course, to the Personal Consumption Expenditures Index, the PCE, the favourite gauge of the Fed. It's expected to come in essentially in line with the previous months. It's expected to give some modest comfort. As Justina was saying, look, you're going to need more, clearly you're going to need more than 1 month to assuage most members, at least, of the FOMC.
Yeah, and again, this is tricky. This speaks to the volatility that we're seeing, the fact that we're still seeing 9-10 basis point moves in the U.S. Treasury from, again, comments from a non-voting member. It speaks, I think, to this kind of uncertainty, these jitters that are being baked into the market. Arguably some jitters being baked into the equity market as well on both sides of the Atlantic. NVIDIA was kind of the game changer in the last 5 days. It's gapped higher twice as well. But here in Europe, we are absolutely watching the deal front. BHP Anglo, BHP coming out roaring this morning and basically saying we need a little bit more time. I want to get a quick check on the share price here because the shares are actually rallying on the back of those comments. The deadline was 5 p.m. UK time, and it looks like those shares are higher by 1.4%. Does Anglo then give them that extension?
That $47 billion deal, the timeline, the deadline, 5 p.m. UK time. It looks like they're obviously, as you say, pushing to have that extended. The expectation is that maybe that comes to the fore. We wait for that Anglo response then. And of course, as we've been saying, it is their assets, Anglo's assets in South Africa, that remain a sticking point in terms of how those are restructured and what that would mean for Anglo's investors. Let's check on the airline story as well. This is one that Kriti jumped on early doors, was the read across from American Airlines and their cut to their outlook. And you're seeing that read across to the likes of IAG and Lufthansa here in Europe as well. So added concern around the airline space on the back of that cut to outlook as we head into that crucial summer season. IAG down a full 3%, Lufthansa taking a knock of 2%, and Air France, of course, over in France, down 2.5%. Siemens Energy was also one that jumped to your attention, Kriti.
It was. There's a kind of read through here between Siemens and airlines as well. And at the core of it, it's labor costs, right? Siemens talking about it potentially lessening their workforce by about 4,000 jobs.
Big. Again, that's big.
It's massive,
for
but it's still
company.
Only a potential.
Yeah.
Absolutely. And I think it speaks to some of the issues that you're seeing in Siemens Energy as well. But even in the airline space, this is a continuing conversation that even though you are seeing record demand, that should be music to so many of these executives' ears. They're saying we cannot capitalize on it because, one, jet fuel costs are still rising. You are seeing labor costs rising as well. You are also not able to really increase some of these airline fees, for example. So whereas you are talking about higher airfares perhaps in Europe, being able to capitalize on it, there was real political pushback in the States as well from doing that, because at the end of the day, look at some of the inflation data. The airlines have been driving some of those pressures on people's wallets.
And the supply chain challenges as well, because, oh, by the way, you can't get hold of aircraft because of what's going on with Boeing. Ryanair here in Europe is an effect of that. Of course, American Airlines is exposed to that story. Ryanair, of course, getting most of its jets, all of its jets, in fact, from Boeing. So they face that as a challenge. Ryanair saying that they see softer pricing in the summer season, despite, as you say, that higher demand, a constrained capacity, because they can't get more aircraft onto those various routes. EasyJet telling us that they couldn't put a number in terms of the pricing they see from summer. So that's clearly a soft spot. It seems the crucial summer season is maybe not going to be as perky as these airlines would have hoped.
And we should talk about the theme here as well from the geopolitics, because there is concerns about getting some of the fleet into Israel, for example, and Tel Aviv being a major hub for a lot of these major airlines as well. And when you remove that demand and kind of reallocate it, you're still going to be taking a hit ultimately on that lost ticket revenue from the region because of the geopolitics and because of the war that we are seeing there as well. So that's going to be something we monitor very, very closely. But then backing out as well, there's plenty to digest as well on the economic front when it comes to how we're getting commentary coming out from some of the politics from the rest of Europe. I'm not sure how to phrase that with a smooth transition, but here we are. Germany's finance minister won't yield to pleas from cabinet colleagues for more money in next year's budget. That, of course, according to German Deputy Finance Minister Florian Toncar. He also told Bloomberg that Europe needs to get more competitive.
I think that the crucial thing strategically, I think, is are we courageous enough to allow for banks which are operating cross-border in Europe, which are operating transnationally under a common supervisor, the ECB? Are we really allowing them to use their capital where it's most efficient, or are we ring-fencing in every jurisdiction? Then we have a fragmented banking market, and therefore we lose economic perspectives and economic opportunities.
OK, that was Florian Toncar then, Germany's Deputy Finance Minister, speaking to Bloomberg's Oliver Crook in Frankfurt about monetary union, closer monetary union, and the need as well to put in place additional measures to make it easier, frankly, to wind down at least small banks. It seems like they're getting closer to a mechanism, to agreeing a mechanism that would make it easier to wind down smaller banks that are troubled. What they then need to move on to is joint insurance deposit or deposit insurance, the kind of system you have in the US that's not yet in place in Europe. And clearly the need for this is significant given the demands around energy and defence spending.
Yeah, I never connected the dots that we have that FDIC protection as well. I think it insures like $250,000 in sort of savings accounts. Yeah. It's interesting because, again, it's coming at a time when we have some real numbers on it. You mentioned Christian Noyer as well, the former Bank of France governor. He said $1 trillion needed by 2030. He also said that if you look at some of the savings, you can get there, sort of. 200, I think, billion is what he said per year. So you get there, but it's still not full to get to that full $1 trillion. When you ask him how do you actually get there seems to be a lot of questions about doing that at a time when people are actively pulling out of Europe.
And questions about implementation as well. Let's take a quick look at some of the other events today. Of course, South Africa votes. They're going to the polls in one of the most consequential general elections since 1994. Meanwhile, on the economic data front, German CPI comes out at 1 p.m. UK time. We're also looking at the Fed's Beige Book, 7 p.m. UK time, and more Treasury details around the buyback, the debt buyback. That is it for markets today. The Pulse is up next. This is Bloomberg.